If you are over 60, your bank account is operating under a completely new set of digital tripwires right now. Under the IRS's aggressive 2026 automated monitoring upgrades, banks are quietly flagging accounts for behaviors that look perfectly normal to you but look like tax evasion to an AI algorithm. The worst part? The move that triggers an immediate asset freeze is likely something you think is completely legal. If you want to protect your life savings, you must stop making these 3 specific moves immediately before the system flags your account next. Every single day, thousands of honest retirees are waking up to find their debit cards declined, their checks bouncing, and their online banking access completely locked out. They haven't done anything wrong. They aren't hiding millions in offshore accounts. They are simply managing their own hard-earned money the way they always have. But the rules of the game just changed completely. If you don't know what these new digital tripwires are, you are flying completely blind. To understand why this is happening right now, we have to look at how much the banking system has changed over the last few months. The IRS recently completed a massive, multi-billion-dollar technological upgrade. They didn't just hire more human auditors, they deployed incredibly powerful, automated AI software systems directly into the back end of the US banking network. In the past, if you made a slightly unusual withdrawal or deposit, a human bank teller who knew your face might handle it, or a manager would look at your history and realize you've been a loyal customer for 30 years. Those days are officially gone. Today, algorithms do the watching. These programs don't care about your character, your decades of honest tax paying, or your retirement story. They only look at data patterns. And if your financial pattern trips their system, your account is automatically flagged for review. For a senior living on a fixed income, an account flag isn't just an inconvenience, it is an absolute nightmare. It means your Social Security direct deposit can be held in limbo. It means your automated payments for your mortgage, supplemental health insurance, or daily utilities can bounce, triggering massive penalties. And trying to untangle your money from an automated freeze can take weeks of sitting on hold with automated phone trees, trying to prove your identity to a computer program. The good news is, you can completely avoid this nightmare if you know exactly what behavior the system is hunting for. But while keeping your local cash transparent is vital, it's nothing compared to the massive trap seniors are falling into when they try to move their own retirement nests to higher-yielding accounts. Which brings us directly to the very first mistake you need to stop making today. Let's start with something incredibly common. Imagine you want to help your grandchild buy their first used car, pay for a semester of college, or put a down payment on a house. You have the cash sitting safely in your savings account. You know that banks have to report any cash transaction over $10,000 to the government, and frankly, you just don't want the hassle of paperwork or the bank asking you a million questions about your personal life. So, you decide to be clever. You go to the bank on Monday and withdraw $3,500. Then, the following week, you go to a different branch and take out another $3,500. A few days later, you take out the remaining $3,000. In your mind, you are just quietly managing your money, staying well below that scary $10,000 threshold. In the financial world, this is called structuring, and under federal law, it is a massive red flag. The automated systems tracking your account are explicitly programmed to look for patterns of deposits or withdrawals that look like they are intentionally trying to avoid the $10,000 reporting limit. To the computer algorithm, breaking a large sum down into smaller, frequent chunks doesn't look like an innocent grandmother helping her family, it looks like a criminal trying to bypass federal tracking. The irony is, if you had just walked into the bank and withdrawn the full $10,000 at once, the bank would have filed a standard routine document called a currency transaction report. It takes 2 minutes, it happens millions of times a day, and as long as your money is legal, nothing happens. It's completely safe. But when you break it up, the system automatically triggers a suspicious activity report. You won't even know this report has been filed. The bank is legally forbidden from telling you that they filed it. But behind the scenes, your account is now flagged, and your funds can be locked while the system runs a deep forensic check on your entire financial history. Never try to outsmart the algorithm by breaking up your money. If you need to move or gift a large amount, do it all at once, transparently, and with a clear paper trail. But while keeping your local cash transparent is vital, it's nothing compared to the massive trap seniors are falling into when they try to move their own retirement nests to higher-yielding accounts. Right now, traditional brick-and-mortar banks are paying terribly low interest rates on basic savings accounts. On the flip side, online banks are offering fantastic high-yield savings accounts. Naturally, many retirees are doing the smart thing. They are moving large portions of their retirement distributions, pensions, or 401k payouts to these online institutions to earn an extra few $100s a month in interest. However, moving a large chunk of money between two different financial institutions is exactly where the new automated fraud filters are snapping shut. Here is how the trap works. If you open a new online account and initiate a rapid transfer of $25,000 or $50,000 from your old bank, the automated security systems on both sides immediately compare the digital profiles of the two accounts. If there is even a tiny discrepancy, say, your old account includes your middle name, but your new account only uses your middle initial, or your old account is tied to a landline phone number while the new one uses your cell phone, the algorithm goes on high alert. Because senior citizens are the primary targets of sophisticated financial scams and elder fraud, banks have dialed their protective algorithms to maximum sensitivity. The system doesn't see a smart investor moving money for a better interest rate. It sees a potential hacker or scammer trying to drain a senior citizen's life savings into an unverified online account. Instantly, the transfer is halted. The funds are placed in a legal holding pattern, and both accounts can be restricted until you provide physical, notarized proof of your identity. To prevent this, never move large sums of money electronically right after opening a new account. Instead, call your bank directly or visit a branch in person and request a physical cashier's check or a formal wire transfer. Yes, it takes an extra step, but it leaves an unassailable paper trail that the automated system cannot misinterpret. And if you think keeping your money sitting completely still protects you, you need to see what the heirs just changed regarding your physical identity records at the bank. This third move catches thousands of retirees completely by surprise every single year, especially those who love to travel, live part-time in warmer climates, or hold dual citizenship. Let's say you own a small, modest vacation condo in Mexico. Or perhaps you kept a small legacy bank account in Canada or Europe from a business venture years ago. Maybe the account only holds $11,000 or $12,000 just to pay local property taxes or utility bills for your vacation spot. You aren't earning massive income on it, so you assume the heirs doesn't care. That is a dangerous assumption. Under federal law, if you hold an aggregate balance of over $10,000 in foreign bank accounts at any single point during the calendar year, even for just 24 hours, you are legally required to file a special form called an FBAR, a bank account report. In the past, the government relied heavily on self-reporting for these smaller foreign accounts. But under the new international digital banking agreements, foreign financial institutions are now automatically sharing data directly with the heirs database. If the heirs computer scans your tax return and sees no FBAR disclosure, but the foreign bank's computer reports that your account crossed that $10,000 threshold, the system triggers an automatic audit flag. The baseline penalty for failing to file this simple form starts at a staggering $10,000, even if you don't owe a single penny in taxes on that money. If you have any overseas accounts, or if you are transferring money internationally to fund your retirement travels, ensure your CPA or tax preparer is filing your FBAR forms every single year without fail. Which brings us to the most urgent development of all. The hidden rule change that is officially cutting off the old school way retirees interact with the financial system entirely. Now we come to the most critical revelation of all, the ultimate reason why bank accounts are being flagged at unprecedented rates this year. The U.S. Treasury has quietly begun the final phases of a massive plan to entirely eliminate traditional physical paper checks for federal distributions. The system is forcing a mandatory 100% digital integration. Because the government is trying to eliminate the billions of dollars lost to mail theft and identity fraud, they have passed the burden of verification entirely onto the banks. This means banks are now legally liable if they accept a direct deposit or process a transaction where the data points don't perfectly align. The true climax of this entire shift is that your bank account is no longer just a place where your money sits. It has been transformed into a government compliance monitoring node. If your Social Security delivery data, your Medicare profile, your legal name on your living trust, or your annual tax filing paperwork doesn't match your bank account record down to the exact spelling, punctuation, and address format, the automated security protocols are designed to flag and freeze first and ask questions later. The safety net you thought you had in your local bank branch has been replaced by an unyielding digital wall. Don't let this terrify you, let it prepare you. You can take control of this situation today by taking 3 simple, proactive steps. 1. Perform a profile audit. Log into your online bank portals or visit your local branch. Verify that your legal name, your physical address, and your social security number match your tax returns and your social security statements exactly. Fix any minor typos immediately. 2. Communicate before you move. If you are planning to make a large withdrawal, give a gift to a family member, or shift funds to a new high-yield account, call the bank ahead of time. Let them note your account so the algorithm knows the transaction is authorized by you. 3. Keep flawless records. Always keep a physical binder with printed receipts, wire confirmations, and legal documents for any transaction over $5,000. The financial landscape for retirees is changing faster than ever before, and the old ways of managing your cash simply won't protect you anymore. If you want to keep your hard-earned savings entirely safe, hit that subscribe button right now. We track these bureaucratic rules and shifting banking algorithms every single week so you can protect your retirement wealth and never have to face an automated account freeze alone. Stay safe, stay prepared, and we will see you in the very next video.